is all about. You all mic'd up? Yep. All right, man, have at it.
All right, thank you. All right, great.
Eric, if you need this, clicker is right here, my friend.
Yeah. Are my charts up there? Cool. All right, great. Thank you all for joining. My name is Eric Wallerstein. I'm the Chief Market Strategist at Yardeni Research. You're all probably familiar with Ed and less familiar with me. Coincidentally, this is my last appearance for Yardeni Research. I am joining the Council of Economic Advisors at the White House in May. So I didn't do any of this yet, but I will be there shortly. I'm sure you've all seen, we've been quite bullish for the past few years, and that's been a winning strategy. But throughout the past few weeks, we've been revising lower. At first, our S&P 500 targets on the basis of multiple compression. And then recently this week on Monday, we lowered our earnings estimates for the S&P 500. So our targets have come down. Our recession odds have come up. We're now 55% bullish and then 45% recession odds. Those recession odds are kind of stagflationary on balance, so higher prices, lower growth. It's the worst form of a recession because the Fed can't come to the rescue, as has happened in prior episodes. So we're still not ready to give up on the US. We don't think US exceptionalism ends in a couple months, and I think a few months of outperformance by China, Germany, and whatever other stock markets aren't indicative of those countries being able to weather a recession better than the US. So in terms of hedging whatever the future looks like or the next couple quarters, that probably looks more like a rotation within US stocks than necessarily just plunging into foreign markets. But I'm going to start first with our estimates. I don't even know which buttons do which, but green one? Yeah, I'm going for it. Big green one. Cool. All right. I don't know how to go backwards, but we'll get there. Here we go. Okay, so our earnings estimates for this year and next were 285 and 320 earnings per share for the S&P 500. That's now down to 265 for this year and 300 for the following. So you get a forward earnings of about 300 for this year, and then we're looking at 350 for the following. So analysts are cutting estimates. They're usually slow to do it. We think forward earnings are probably the best measure of where the stock market's going to go. They closely measure actual earnings, but bottoms-up analysts don't do a good job of forecasting recessions. I guess that's what we're here to do. So our price to earnings target was 18 to 22. As you guys know, the Mag 7 were pretty richly valued. The rest of the market was around 20, 21. And so we've lowered that as well. We're now down to 20 to 17. Probably the bottom end of the range is what you're likely to get, if not lower, in a recessionary situation for the economy, which I think we would see in Q2 or Q3 if it does happen. And we really, Scott Bessent, the Treasury Secretary, said this yesterday, but I think it was about the broad sell-off, is that it was a Mag 7 problem, not a MAGA problem. And that's true. If you look at the data, broadly NVIDIA and Tesla, but just the Mag 7, their multiples compressed from 30, 35, down closer towards 20 to 22. So long-term earning growth expectations, the forward PE for NVIDIA, for Tesla, and for the Mag 7 broadly, were much closer in line with the kind of their historical averages. What do you expect from a tech company that's growing quickly but at a decelerating basis? And it looked like there wasn't much more room for that. So earnings have to actually come down for the Mag 7, I think, for them to do quite poorly this year. But on a multiple basis, you actually had value and large cap value doing pretty well. I'm going to cut off today and yesterday, but large cap value was up over year to date. Over the past month, it was roughly flat. And the multiple for basically the S&P 493, so cutting out the Mag 7, was around 19 or 20. That's not a recession. That isn't a bad outlook. That was just uncertainty weighing on the multiple of, by all accounts, richly valued stocks. We've been asking for the past 2 years, how long could NVIDIA and Apple and the Mag 7 be valued at this high? At some point, right, the PE has to come down. And I guess that's what we saw recently with the uncertainty. So we'll see what happens with tariffs. I really think that the key to US growth going negative or stagnating at a very low level is Canada and Mexico. I think supply chains are in a much healthier place today than they were when COVID happened, because we've just gone through the pandemic and we've reshaped supply chains. If Canada and Mexico is figured out and then some other trade barriers are negotiated lower, listen, we're not going to a world where there's no tariffs or where there's a 5% tariff rate or a 10% tariff rate on average on imports into the US. It's just not going to happen. But I think supply chains are much more resilient. So if we figure out this kind of free trading bloc in North America and negotiate some deals with other key partners, Japan, Vietnam, since China exports a lot through Vietnam, then I think we'll be broadly okay. But if tariffs stick at this high of a level and or there's no real certainty over the next couple quarters, it's extremely likely that investment falls, consumption falls, people start to save more, and we actually do get a stagflationary recession. And I'm going to go back, actually, to this chart, which has really underpinned a lot of our bullishness for the past couple years. And also, feel free to interrupt me throughout. Like, there's a lot going on. Just feel free to ask a question. I don't really care. Baby boomers own more than half of the wealth in the US. More than 80 trillion of $160 trillion of household wealth is on baby boomers. There was a wave of retirements during COVID, and the income that baby boomers have is from Social Security and entitlements and investment income. As the price of homes rose and stayed pretty high, as stock prices rose, it kind of incentivized this saving from the baby boomers, and they kept spending. It's why services spending has been so incredible. It's why leisure and hospitality is basically fueling the entire gain in the labor market. You know, a lot of people talk about federal employment. It was pretty much all state and local governments that were hiring workers. So you had teachers, healthcare workers, local governments, which is in part due to a lot of immigration, right? When 8 million people come into the country and they skew younger, you have to hire more teachers and administrators. But the rest of it was leisure and hospitality, retail, healthcare. So they kept spending, and I think if this group decides that they can't spend as much, because when you see that your source of wealth and income is down 15% over a few days or a couple months, it probably incentivizes you to put that on pause. I think you could actually get that huge wealth effect turning negative, and it does have an outsized effect. Is a 15% correction in the S&P 500 from a record high, like, horrible? Is it the worst downturn we've ever seen? No. It's a correction from a pretty high multiple and very lofty expectations priced for perfection. But based on how much of consumption has been fueled by rising home prices and rising stock prices, you probably get a lot of uncertainty and sentiment bottoms or falls towards bottoms. The issue with consumer sentiment, I'm sure you've seen the University of Michigan consumer sentiment, probably your own sentiment at home, various indicators showing that we're all pissed off, we're all sad, we don't think we're going to spend, jobs are going away, blah, blah, blah. They've been depressed for like 3 years. And it actually hasn't showed up in the spending data, right? We still go on vacations, we still go out to eat, we still go to bars, we still go to concerts, which become increasingly expensive. The issue with consumer sentiment going towards lows, and like AAII, the bears are up in arms, and all these sentiment indicators show that everyone's bearish, no one wants to spend, is that they only bottom, and we're at like 2009, 2020 levels of how scared we all are and how nervous we are. They only bottom if there's a policy put. There has to be a policy response. And I think it's not going to come from the Fed, at least not now. Chair Powell spoke today and said, we have to balance two goals, and their inflation mandate is far more out of balance than their labor market mandate. We're at full employment, 4.2% unemployment. We've added over 150,000 jobs on average for the past 3 months, which is pretty good considering there's been no immigration, basically. You had 200,000 plus payrolls gains each month because a lot of people were coming into the country. 150,000 is probably above that break-even rate that the economy still grows at. So they're going to keep their foot off the gas. They're not going to cut rates. If a financial crisis does emerge somehow from this, that would be the only way to get some easing and get some QE. I was actually at the New York Fed during 2019 and 2020 when we did all the QE, so I was pressing the buttons, but not making decisions, obviously. And there are a lot of tools at the Fed to stem a financial crisis, and it's why SVB and the regional banking crisis in March of 2023 didn't go out of control, because it's the place the Fed and the Treasury have the most control, is the banking system. This is a very real economy issue. Like, trade policy hasn't been a huge concern since basically the 70s, and then the dollar devaluation stuff in the 80s. It's something we're not accustomed to, and it's something that probably requires a response from Congress or the current administration to really shore up. We'll see what's negotiated over the next few weeks, next few months, but for the time being, I think the nascent recovery in the goods sector and manufacturing is probably on hold. I think consumer spending has been flagging a little bit on services. It's probably going to continue falling. Goods spending is going to go way down after this huge run-up we just saw over the past couple months. I'm not buying a car next month. I doubt many people are. All the gold imports, all that stuff is going to go away, and then we might be seeing sub 1% real GDP growth, if not negative, over the next couple quarters. So that's the negative stuff. I do want to kind of counterbalance this because I do think, and we do think, the U.S. economy is entering this period on far better footing than the rest of the world. Germany and Europe were dealing with recessionary conditions almost and high inflation coming into this year. China is trying to export its way out of a bubble that burst and no one knows the actual size of. It is huge, and they're not going to figure it out anytime in the near term. And the US was doing pretty good, and we still have a pretty strong labor market. So I do want to give you some good news, or maybe we're not all so depressed from looking at our portfolios. So this is real GDP growth. It's averaged between 2% and 3% over the past couple years. Historically, that's where it's at. And all things equal, if this was a month ago or 2 months ago, this is probably where we were heading, even with less immigration and less fiscal spending. And that is because productivity growth. We're big believers in the productivity growth boom. It's been working for the last 5 years. We think it still will happen over the next 5 years. And if you see like a lot of the announcements in AI, automation, technology, those are still happening, right? Those investments are still happening. Venture capital has more money than they know what to do with. It's still going to go towards AI, and productivity growth is going to increase. And companies probably have some incentive after they reshore and we lose some productivity from supply chains being shifted. They have incentive to invest in productivity-enhancing technology because US labor costs so much more than basically everything they've been used to. So over time, we find that output or real GDP growth is about 2/3 productivity growth. So we had a huge boom in the labor force. We let in 8 million more people over 2023 and 2024 that otherwise wouldn't be here. Even though we had a lot of retirements, we had a lot more immigrants coming in. Immigrants tend to work because they're younger and they're coming here to work and get money. We think productivity is going to be the big driver of real GDP growth for the next couple years and arguably into 2030. This is a big part of why European stock markets haven't done anything until basically January. Or their economies aren't doing so well. The German DAX has done pretty well relative to the US recently, and over time it's near a record because SAP is a big AI winner, and their market is quite concentrated, just like ours. But US productivity growth has been increasing on a pretty steady trend, and the EU has basically been flat for 20 years. This is something you can see similar across the rest of the developed world. But we're just much better at using technology. Our workforce is much more adaptable. During COVID, basically, the EU incentivized employers to hang on to all your workers. They paid them to not fire anyone. And that prevented what in the US was a huge productivity boom because people got fired and they went to different jobs. They were able to use their skills elsewhere where they were most needed. And then we also had a lot of immigrants come and backfill some of the lower productivity jobs. But it helped us from a productivity perspective. And we think that productivity growth could reach 3%, if not 3.5%, by the end of the decade, tariff turmoil notwithstanding. And this is why it matters, because productivity growth is real wage growth. Whether your wages are rising at 5% or 2%, you care about what that means for you after inflation. And when inflation was very high, especially the lower income to lower middle class workers were losing out relative to inflation. But productivity growth has increased. Inflation has fallen, and so we've gotten actual real wage growth even at the bottom quintiles, bottom half, bottom 75%, whatever you want to say. They've been outpacing inflation. You've had real wage gains. You've had income transfers from the government. It's kind of what's fueling people who don't own assets to keep spending and keeping the economy going. And this is also why it matters, because productivity growth inherently reduces unit labor costs. It is the most expensive part of a services-driven economy. Even as tariffs come online, we still will be a services We still will be a services-driven economy, so keeping those unit labor costs down is what's very important to companies in expanding their profit margins and basically just continuing to grow earnings at a higher level. And my last chart before I open it up to Q&A is profit margins. So we haven't touched our revenue forecast yet for this year. We are considering it and considering raising our recession odds to higher than 50%. And I don't even know if I put profit margins in here, but regardless, we think profit margins will reach an all-time high of 14% next year. Some of that is just the constitution of the US stock market, right? It's pretty tech heavy, so like tech companies have higher profit margins, but also we think productivity growth will help. So you get wider profit margins, you can probably weather some of the tariff storm, weather lower earnings expectations, etc. That was a lot of talking. If you guys have questions, please ask. I'm happy, this is the views of Yardeni Research, but I've been thinking about tariffs a lot, obviously, so whatever you guys have, I'm happy to answer. Yeah, go ahead. Oh, I think we have a mic coming. Oh, there we go. If we could just pass it up. All right.
Thank you. I guess stated another way, if you took out income transfers that you mentioned for real gains, would they still exist?
Yeah, and I have a real gains chart, which might help. But yeah, so since 2024, basically, real wage gains for production and non-supervisory workers, so everyone who's not, I guess, us, has been positive. So real wages have been outpacing inflation. The issue is if you had a 50% cumulative increase in prices on essentials for the past couple years, it doesn't really feel like you're beating inflation. But so for at least a year plus, real wages have been going up. And this is average hourly earnings, so excluding transfers from the government.
Yes. With the tariffs, do you think that's going to cause inflation?
Yeah, so a big source of disinflation, and it's why we thought the Fed was misguided in cutting 100 basis points last year, has been goods deflation. Goods prices have been actually falling for the past year and a half, mostly because Chinese exports, China doesn't know what to do. They haven't really incentivized consumption, so they're just exporting everything they possibly can, and that's led to falling goods prices for a year and a half, if not 2 years. As base effects take hold, like we're coming off negative prices a year ago, and as tariffs actually feed through to consumer prices, you're going to get goods inflation. It already started in February. It's going to be much higher in March and throughout the rest of the year, basically. Services are disinflating, but quite slowly. And the worry is that rising goods prices will actually filter into wages and whatever else. You don't get that in a recessionary standpoint, but core PCE probably gets to 3-4% this year. So that's why we think it's going to be really hard for the Fed to cut. And barring a financial crisis, I don't think they cut at all this year.
How would a stimulus like the tax cuts affect the economy short-term and long-term?
Yeah, so tax cuts are good. It kind of helped underpin some of our bullishness in November, and we were among the most bullish. We were among the most bullish to start, and then we got more bullish in November. The issue is tariffs are also a tax, and they're happening right now. And when do tax cuts happen? And are tax cuts, like extending the TCJA, is great for fiscal scoring for the CBO, but it doesn't actually change our behavior because it was already happening, right? It might change corporate planning to some extent, but not when tariffs are happening as well. So if you do get actual income and corporate tax cuts, then that's fantastic, but what if they don't come till 2026? So we're having a tax hike as we speak, and that's negative for growth. Therefore, you kind of have to lower your growth expectations. So they'll be good at some point if they happen.
Here you go, ma'am. What does the current administration wants to keep the U.S. dollars at? Do you know?
What's the ideal dollar policy? Yeah, so there's been a lot of speculation over the past couple days that tariffs would be higher prices from tariffs would be offset by a stronger dollar, and kind of people pointing fun at the administration, saying, oh, well, that idea existed in 2018, 2019. Now the dollar is falling. It's down year to date, but it's been pretty volatile for the past few years, generally outperforming. The thing is, the administration does want a lower dollar to incentivize our exports and manufacturing sector. And the whole idea behind tariffs and reshaping international trade is that a persistently overvalued dollar has crimped our exporting sector, right? Like, it's great because we can spend money and travel quite nicely, but it doesn't really help our exporting business, and our real exchange rate is so lofty. It's why, like, you probably know a lot of people who went to Japan last year because it was incredibly, not only is the yen pretty cheap relative to the dollar, but it's just so much easier to spend money there. It's so much cheaper. So I actually do think a generally weaker dollar, but not so weak, is what this administration wants. And lower real yields and a lower 10-year yield is the method of achieving that. It's kind of what we saw yesterday. I'm not going to put too much weight on any one day of trading, especially when yields are plummeting. But I think generally you want to see lower real yields, a slightly lower dollar, and that should help balance trade over time. But it's going to be volatile for the next couple quarters at least. All right, and thank you so much. It was great to be here. Thanks for your questions.
Well